Financial fraud has existed for centuries, exploiting human greed and trust for personal gain. These schemes have devastating consequences, not only for the victims but also for the broader economy. Here's a glimpse into 5 of the most infamous financial frauds in history, highlighting the staggering sums of money involved. Please give us a thumbs up, hit that subscribe button, and don't forget to activate notifications for the latest updates. 1. Bernard Madoff's Ponzi scheme, $64.8 billion. Bernard Madoff, a former stockbroker and investment advisor, orchestrated the largest Ponzi scheme in history, defrauding thousands of investors of an estimated $64.8 billion over decades. His scheme was based on a simple premise: paying early investors with funds from new investors, creating an illusion of high returns. How the scheme worked. Madoff claimed to use a proprietary trading strategy that generated consistent returns, regardless of market conditions. He attracted investors by promising steady returns of 10–12% annually, which were significantly higher than average market returns. Investors were enticed by the promise of such high returns and the credibility Madoff had built over his long career. He was a respected figure in the financial industry, serving as the chairman of the Nasdaq Stock Exchange, and his firm, Bernard L. Madoff Investment Securities, BLMIS, had a long and seemingly successful history. The collapse. Madoff's scheme continued to operate for decades, fueled by a steady stream of new investors. However, in 2008, as the financial crisis worsened, more investors began requesting withdrawals. With no real investments to generate returns, Madoff could no longer maintain the illusion of high returns. In December 2008, Madoff confessed to his sons that his investment business was a fraud. They alerted authorities, and Madoff was arrested on December 11, 2008. On March 12, 2009, Madoff pleaded guilty to 11 federal felonies and was sentenced to 150 years in prison, the maximum sentence allowed. The impact. The Madoff scandal had a devastating impact on investors, charities, and the financial industry as a whole. Thousands of individuals and institutions lost their life savings, and many charities and foundations were crippled by their losses. The scandal also eroded public trust in the financial industry and led to increased regulatory scrutiny. Lessons learned. The Madoff scandal serves as a stark reminder of the dangers of investing in schemes that promise high returns with little or no risk. It also highlights the importance of due diligence and the need to be wary of investments that seem too good to be true. The Securities and Exchange Commission, SEC, has taken steps to strengthen investor protections in the wake of the Madoff scandal. These measures include increased disclosure requirements for investment advisors and enhanced surveillance systems to detect suspicious trading activity. 2. Enron's accounting fraud, $63 billion. Enron, once a symbol of corporate success and innovation, became synonymous with fraud and deceit when its accounting scandal erupted in 2001. The company's collapse, with assets of $63 billion, was the largest bankruptcy in U.S. history at the time, sending shockwaves through the financial world and shattering the trust of investors and employees alike. How the fraud unraveled. At the heart of Enron's demise was a complex web of accounting schemes designed to hide billions of dollars in debt and inflate earnings. The company's executives created a labyrinth of off-balance sheet entities, known as special purpose entities, SPES, to move debt and losses off Enron's balance sheet. These SPES, often controlled by Enron executives, would engage in financial transactions with Enron, artificially boosting the company's earnings and financial position. The company also used mark-to-market accounting, allowing it to value its assets at inflated prices, further distorting its financial performance. The role of executives and auditors. The Enron scandal was not just a case of accounting irregularities. It was a deliberate effort by top executives to mislead investors and enrich themselves. Enron's CEO, Jeffrey Skilling, and its chairman, Kenneth Lay, were at the center of the fraud, orchestrating the complex accounting schemes and reaping millions of dollars in personal gains. Arthur Andersen, Enron's auditing firm, played a crucial role in enabling the fraud. The firm failed to adequately scrutinize Enron's accounting practices and turned a blind eye to the company's questionable transactions. In 2002, Arthur Andersen was convicted of obstructing justice for shredding documents related to Enron's audit, leading to its eventual collapse. The aftermath. The Enron scandal had a devastating impact on the company's stakeholders. Thousands of employees lost their jobs, and shareholders saw their investments plummet to near worthlessness. The scandal also eroded public trust in corporate America and led to increased regulatory scrutiny and reforms. The Sarbanes-Oxley Act of 2002 was enacted in response to the Enron scandal, aiming to strengthen corporate governance and protect investors. The act introduced stricter accounting and auditing standards, enhanced corporate disclosure requirements, and established the Public Company Accounting Oversight Board, PCAOB, to oversee the auditing profession. Lessons learned. The Enron scandal serves as a stark reminder of the consequences of unchecked corporate greed and the dangers of complex financial instruments. It highlights the importance of corporate transparency, ethical leadership, and effective regulatory oversight. The Enron scandal transformed the corporate landscape, leading to significant changes in accounting practices, corporate governance, and regulatory oversight. 3. WorldCom's accounting fraud, $11 billion. WorldCom, once a telecommunications giant, became synonymous with corporate fraud when its massive accounting scandal unfolded in 2002. The company's revelation of $11 billion in fraudulent accounting entries sent shockwaves through the financial world, leading to its bankruptcy and the indictment of several top executives. The anatomy of the fraud. At the heart of WorldCom's scandal was a systematic effort to inflate earnings and hide massive expenses. The company's executives, under the leadership of CEO Bernard Ebbers, employed a variety of deceptive accounting maneuvers to create a false impression of financial health. One of the primary methods used was capitalizing line costs, which are ongoing expenses related to telecommunication services. Instead of expensing these costs as they were incurred, WorldCom improperly capitalized them as assets, inflating its profits. The company also engaged in round-trip transactions, which involved selling assets to off-balance sheet entities and then buying them back at inflated prices, creating a false appearance of revenue. Additionally, WorldCom used false accounting entries to conceal massive expenses related to its acquisition of MCI Communications. The unraveling. WorldCom's house of cards began to crumble in 2002 when internal auditors, led by Cynthia Cooper, discovered discrepancies in the company's accounting records. Their investigation revealed the extent of the fraud, leading to WorldCom's confession of $11 billion in false accounting entries. The revelation sent shockwaves through the financial world, causing the company's stock price to plummet and erasing billions of dollars in shareholder value. WorldCom was forced to file for bankruptcy in July 2002, becoming the largest corporate bankruptcy in U.S. history at the time. The indictments and aftermath. The fallout from WorldCom's scandal extended beyond bankruptcy. Several top executives, including CEO Bernard Ebbers, were indicted on charges of securities fraud and conspiracy. Ebbers was convicted and sentenced to 25 years in prison, while other executives received lesser sentences. The scandal also led to significant regulatory changes, including the passage of the Sarbanes-Oxley Act of 2002. This act aimed to strengthen corporate governance and financial reporting standards in an effort to prevent future accounting scandals. Lessons learned. WorldCom's accounting fraud stands as a stark reminder of the devastating consequences of corporate greed and deception. It highlights the importance of ethical leadership, strong internal controls, and effective regulatory oversight in maintaining financial integrity. The scandal also underscores the critical role of whistleblowers in exposing corporate wrongdoing. Cynthia Cooper's courage and diligence in uncovering WorldCom's fraud played a pivotal role in bringing the company's executives to justice and protecting investors from further harm. 4. Wachovia's money laundering scheme, $380 billion. Wachovia Bank, once a prominent financial institution in the United States, became embroiled in a massive money laundering scandal involving Mexican drug cartels. The bank's failure to report suspicious transactions worth over $380 billion, spanning from 2004 to 2007, enabled drug cartels to launder their illicit profits and fueled their criminal operations. The facilitator of illicit funds. Wachovia's correspondent banking relationships with casas de cambio, CDCs, or money exchange houses, served as the primary channel for drug cartels to launder their money. These CDCs, often located along the U.S.-Mexico border, acted as intermediaries, depositing cash proceeds from drug sales into Wachovia accounts. Wachovia, despite clear red flags and warnings from law enforcement agencies, turned a blind eye to these suspicious transactions. The bank failed to implement adequate anti-money laundering (AML) controls and ignored numerous instances of large cash deposits, unusual wire transfers, and other indicators of illicit activity. The extent of the scandal. The magnitude of Wachovia's involvement in money laundering was staggering. The bank processed over $380 billion in transactions for Mexican CDCs, a significant portion of which was linked to drug trafficking. This facilitated the cartel's ability to operate and expand their criminal enterprises. The bank's negligence not only enabled drug cartels to launder their illicit gains but also contributed to the violence and corruption associated with the drug trade. Wachovia's actions fueled the flow of illegal drugs and undermined efforts to combat drug trafficking. The fallout and consequences. In 2010, Wachovia entered into a deferred prosecution agreement with the U.S. government, admitting to its role in money laundering and agreeing to forfeit $160 million and implement stricter AML controls. The bank's reputation was tarnished, and its stock value plummeted. The scandal led to increased scrutiny of the financial industry and highlighted the importance of robust AML practices. Regulators strengthened AML regulations, and banks were required to enhance their oversight of correspondent banking relationships and implement stricter due diligence measures. Lessons learned. Wachovia's money laundering scandal serves as a stark reminder of the devastating consequences of financial institutions failing to uphold their AML obligations. It underscores the critical role of banks in preventing money laundering and disrupting the flow of illicit funds. Wachovia's failure to prioritize AML compliance created an atmosphere that enabled illicit activity to flourish. In the aftermath of the scandal, Wachovia was acquired by Wells Fargo, and significant reforms were implemented to strengthen the bank's AML program. 5. Satom Computer Services accounting fraud, $1.47 billion. Satom Computer Services, once a thriving Indian IT firm, became synonymous with corporate fraud when its accounting scandal erupted in 2009. The company's founder and chairman, B. Ramalinga Raju, confessed to fabricating earnings and inflating assets over several years, resulting in a $1.47 billion fraud. The fabricated reality. At the heart of Satom's scandal was a deliberate effort to inflate the company's financial performance and mislead investors. Raju and his accomplices created fictitious invoices and bank statements to create an illusion of non-existent revenue and cash balances. The company's inflated financial statements were used to secure lucrative contracts and attract new investors. Satom's stock price soared, and Raju was hailed as a visionary leader in India's booming IT industry. The unraveling and confession. The facade began to crumble in late 2008 when Satom attempted to acquire Madoff Properties, a real estate company controlled by Raju's family. The deal raised concerns among investors and analysts, prompting scrutiny of Satom's financial statements. As pressure mounted, Raju made the shocking confession in January 2009, admitting to the years of financial fraud. He explained that he had resorted to fabricating earnings to maintain investor confidence and meet unrealistic growth expectations. The fallout and consequences. Satom's confession sent shockwaves through the Indian corporate world and the global IT industry. The company's stock price plummeted, and it was forced to seek government intervention to prevent its collapse. Raju and several other executives were arrested and charged with fraud, conspiracy, and forgery. They were eventually convicted and sentenced to prison terms. The scandal also led to the resignation of Satom's board of directors and the appointment of a new management team. The legacy of deception. Satom's accounting fraud stands as a stark reminder of the devastating consequences of corporate greed and deception. It highlights the importance of transparency, accountability, and ethical leadership in maintaining investor trust and ensuring the integrity of financial markets. The scandal also underscores the need for robust corporate governance practices and effective regulatory oversight to prevent and detect such fraudulent activities. In the aftermath of the scandal, India implemented stricter corporate governance reforms, including enhanced disclosure requirements and strengthened auditor independence. Please give us a thumbs up, hit that subscribe button, and don't forget to activate notifications for the latest updates.